as promised, let's move on. And in this year-end special series on Commodity Central, we take a look at what 2024 looked like for several commodities and what is the outlook for the next calendar year. While it turned out to be a stellar year for precious metals, as Shreyansi was just pointing out, gold and silver rose by about 25 to 30% in calendar year 2024. Brent crude prices, meanwhile, fell by nearly 5%. But it was a mixed bag when it comes to industrial metals. Zinc rose nearly 12%, followed by aluminium, which rose nearly 5 to 6% in calendar year 2024. Lead prices, meanwhile, fell by about 4%. But what led to this and what is in store for 2025? To discuss all this and more, we now have Dominic Schnider, Head of Global Commodities and Forex at UBS Global Wealth Management, Chief Investment Office, now joining us. Dominic, thank you so much for taking your time out and speaking with us here on ET Now. Overall, within commodities as an asset class, the returns were quite diverse in 2024. But what kind of returns should we expect in the next calendar year?
Well, I would say overall, on a broad commodity basis, if you look bottom up at the different commodity areas, I think the asset class can deliver expected spot return of in the high single digit in 2025, clearly driven by a one-off move in the energy complex, a steady increase on the industrial commodities, and also a steady increase on the precious metal side. I would say the decline in row crops that we have seen likely to come to an end, clearly a little bit of an uncertain backdrop when it comes to the softs, which have done particularly well in some of the cases. So overall, high single digit spot appreciation possible in 2025. And I think on top of it, if you consider there are some roll costs, so that's going to be probably around 2%, but the cash collateral still gives you 4% and plus. So overall, looking at 10% total return for 2025 is our base case. Now, I think what is also interesting, you look at some of the correlation between commodities with equities, that has come down as well. So for me, there is a diversification element towards commodities, and that helps you when you think about your broader investment portfolio to have a stable return outlook for next year.
Stable outlook for next year, and correlation between equities and commodities has come down, which means diversification benefits are likely to continue in the next year as well. But Dominic, which base metal are you most bullish on for the next calendar year, and what will your target price be for that particular base metal?
Well, when it comes to the base metal complex, I think from our side, we do look at copper as one of the most interesting metal to hold. Our forecast at this point in time is looking towards $11,000 a ton, so more than 20% upside from here. Underlying assumption is manufacturing can recover, a lot of interest rates cut, and supply availability remains constrained. That gives the metal really the best upside. Second in line from our perspective is probably zinc. We have some supply availability challenges that's likely to persist into the first half, and that should push zinc prices towards $3,400 a ton. Next one in line would be aluminum, but here I would say the upside is a little bit more constrained.
Most bullish in copper, followed by zinc and aluminium. That's the word as far as your preference for 2025 within base metals is concerned. But across the board, do you expect all base metals to rise in 2025, or is there any base metal which could probably decline in 2025? Remember, lead prices in calendar year 24 have declined. Do you expect that trend to continue next year as well?
Well, I think short term, there's still a lot of availability when it comes to nickel. I mean, it does trade on the weak side, a tad above $15,000 a ton. Could it temporarily drop below that level? Absolutely. We see inventories rising across the board. And if I look at our estimates, our S&D supply and demand estimates, then that market is in surplus. And that hefty surplus is likely to persist into next year. So we're looking at a almost 5% surplus as a share of global demand, and that probably keeps prices pretty much grounded for the time being. And also think lead prices likely to remain under pressure, at least in the short term, simply out of the fact that global car sales are being challenging. And I think that can lead to some surplus development and softer prices, particularly in the first half of next year.
All right, so outlook on nickel continues to remain very muted, but China demand also continues to weigh heavy on base metals. Now that China has announced a slew of monetary and fiscal measures for 2025, do you expect Chinese demand to come back meaningfully next year?
Well, I think we need to recognize that Chinese demand is a little bit split. Clearly, everything related to housing is on the softer side. On the other side, we have seen solid export, we have seen robust industrial production. I think policy support is likely to be here with us into, I would say, next year, particularly given some of the risks that we have with regards to tariffs with the US. That's the overarching risk factor, I would say, for industrial metals next year. Because if you look back what happened in 2018, industrial metals did weaken actually by 15% when tariffs were started to be announced. So I think that element definitely is here. But China stimulus support likely to ramp up on the back of this geopolitical development.
Chinese support is expected to ramp up on the back of geopolitical developments next year, but we did talk about non-ferrous metals and now shifting focus to ferrous. What will your outlook be when it comes to iron ore? Do you expect iron ore prices to fall from the current levels given tepid demand from China led by weak real estate demand that we have seen coming from China?
I think generally, as I mentioned before, we do look for, particularly in the second half of next year, a little bit of a broader manufacturing recovery. I know at this point in time that sounds a little bit far-fetched, but ask yourself, what if rates go down 200 basis points or more? You're probably going to see some form of investment activity. So we're laying the ground right now for a manufacturing industrial production uplift in the second half of next year. And I think under that scenario, there's a good case to be made that prices are stable, maybe moving up a little bit, but the surplus market. So I wouldn't be surprised that prices do not really materially move higher from the $100 that we have seen lately. So I would say stable, but not much upside given the structural surplus that we have into next year.
Chinese demand is expected to remain stable next year as well. But Dominic, what will the key triggers be for different commodities in 2025? Which key factors should we keep an eye out on for, say, precious metals, gold and silver, for oil as well as for industrial metals?
Also, I think maybe staying with the metals here, clearly precious metals. What I find interesting is real rates in the US are very high. And I think that's unlikely to last. When I see real rates, I'm looking at the TIPS yield moved above 2%. I think longer term, that's not sustainable. And I also think that some of the market's expectation that the Fed barely needs to cut rates is probably a little bit over exaggerated. So if the Fed does trigger a little bit more rate cuts than envisioned by the market at this point in time, if you look at interest rate futures, I think the conditions are here for gold to go towards $2,850 an ounce. So I think gold still has further upside. So, but we need that Fed narrative to turn around and give it the next push. On top of it, what we also need is central bank buying, which has been super robust, likely to stay robust as well. So these two things need to fall in place for gold to do the next leg. But we're clearly coming towards the end of a very good rally. Staying in precious metal, I find really interesting, and that ties to our manufacturing story I was highlighting, is basically silver. We're looking at silver prices heading toward $36, $38 an ounce, and I think that's a very big upside. That also means the gold-silver ratio can fall towards 75 to 80 times, and I think the underlying assumption is that industrial production demand remains robust. It is already, but I think once the global manufacturing cycle kicks in, people's attention towards silver will definitely improve. And we have seen a lot of supply availability being constrained. I think that all helps the silver price to make a bigger move compared to gold. Staying lastly in the precious metal complex, think about also platinum. Clearly, we need to see better car sales. That's maybe not a narrative that should emerge basically in the first half of next year, but the second half we should see a little bit of a recovery. I think that gives underlying support for platinum, maybe a very interesting metal alongside silver to sell volatility, something that we like in both metals to do. And when it comes to when it comes to basically crude oil, I think the narrative must be OPEC, please keep supply constrained. Demand growth is actually moderating, so it's a commodity that has a little bit upside, but really requires a better global footing at this point in time. There's enough supply availability out there. The good part is that inventories are coming down on a steady basis, but that hasn't been enough for the market to say we can price oil at $80 and higher. So right now the focus still is OPEC, plus please keep supply constrained in order to make sure that the market stays balanced. So with the roll costs or roll gains, in oil, I think wholesaling is an attractive strategy still to deploy for investors.
That's the outlook when it comes to oil, gold as well as silver, where you expect silver prices to touch $36, $37 per ounce. Dominic, thank you so much for taking your time out and speaking with us here on ET Now on what the outlook is for the next calendar year. We'll slip into a short break, but don't go anywhere. Stay tuned to ET Now.
If you like this video, then like, share and subscribe to ET Now.